Omar here, broker and CEO of Alden Mortgage and OMA Realty. So hard money loans. What is a hard money loan? How long could it go for? And what's the criteria for a hard money loan? So before this, let's get on with it, okay? Majority of people associate hard money loans or hard money line lending as high cost, short-term lending, right? So in this video, what we're going to do is we're going to kind of debunk some of it, kind of give you an actuality of what it's for, and what are the requirements and parameters of exactly what a hard money line loan is. So hard money is it's just a fancy word for just saying it's private money. It has nothing to do with any insuring body, whether it's a Fannie Mae, Freddie Mac, VA, FHA, whatever it is. It's usually just in a portfolio. They usually do private equitable firms that will do it, small little firms, and it's just private investors. Yes, you can do 6 months, you can do 12 months, you can do 24 months. You actually could go up to 30 years on these hard money loans. Now, why do people use hard money loans? Hard money loans is just short-term, like let's say you need to go and get a property right away, right? You need to go ahead and get that dialed in. You need to rehab it, and then you're going to go ahead and anticipate that you're going to get out of it in the next 6 to 8 months. Hard money will make it possible for you to get something that, in other words, was not really a loan product that you could possibly get because it won't fall under the Fannie Mae, Freddie Mac guidelines because appraisal's not going, wouldn't go according to plan, or maybe it's like a rundown, just crappy place that no appraisal out there will even touch. It will never pass inspection. It won't pass anything. So, but you know the potential of the value, you know exactly how much that's going to be worth, and you know that you need that initial equity to go ahead and get into the initial capital to go ahead and get that property and get your feet wet and just get that property, right? So, other people's money. That is a term that a lot of people will go ahead and use. Now, a lot of investors, a lot of people, even including myself, I use hard money quite a bit because the worst thing that you want to go ahead and do is to go ahead and tie up your cash onto something that will require cash for you to go ahead and get. Like, let's say, for instance, there's something that will actually fall under an FHA guideline, which now I need capital. I need at least 3.5%. Well, I could actually do 100% financing, but I need money in my account to offset my assets in order for me to qualify for that mortgage, whether it's an FHA, whether it's going to be a 20% conventional, 10% conventional, 3% conventional, whatever it is. In the world of mortgaging, we do need something that's actually called reserves. Reserves is just going to be in addition to your down payment, in addition to what you're already putting towards closing, in addition to what you're already putting into your settlement costs. This is money that you're going to go ahead and need to set aside depending on the loan product that we're going to go ahead and use. And that is going to go ahead and qualify you, because if you deplete your accounts, purchasing one property and then another good deal comes around, well, you're kind of shit out of luck because you can't really get the property that you want on this end because you don't have enough funds in your account because you just completely clean yourself dry. Now you're at the mercy of this house getting done, rehabbed in time, and then you have to go ahead and cash out, refinance it to go ahead and get the money, the initial capital that you went ahead and pulled out. And then another thing that is really, really important, that let's say, for instance, it's going to take you about a year to go ahead and finish the house from beginning to end, to go ahead and rehab it, to get it rented out so you could get into a more steady or more, conforming product. Now, majority of investors, just so you know, including myself, we usually typically go to a 40-year interest only because it's great for investors, and this way you could flip it over. It's still 80% loan to value, and it actually goes into you go into the debt service covered ratio, but we'll get into that into another video. But for instance, in hard money, well, we're going to go ahead and get that hard money, run it that 12 months, then we're going to go ahead and get out of it. We're going to get that initial capital. Now, in that course of that 12 months, let's say something really, really bad happens, like let's say 2022, what we're currently in. And let's say there's a huge market shift that we did not anticipate. Like let's say you bought the house in, let's say December, right? In December, you used hard money. You put your little bit of money, initial investment into it, and after you put your initial investment into it, now the markets have completely changed. you could go ahead and dump out of it, and you don't even have to worry about it, because the collateral on the other side of it is going to be falling onto the hard money lender. Now, if you are on the other side of things, where you're on a conventional, there really isn't much that you could do, because hard money does not qualify you based off of you. Hard money qualifies you based off of the ROI, the ROI, and they'll also do it off of the ARV, which is the after repair value. Now, if they see that the after repair value off of a property that's completely run down is actually, in really, really good standing, that's exactly what hard money will actually qualify you for. So it's not really qualifying you based off of the person, which it does qualify you. You still need good credit score, but it'll look at your credit score, and it'll look at the property. Those are the two parameters that we look when it comes to hard money. And that way we could actually close in like a week. Hard money sometimes is a really, really good way to go. Should you go? If you don't have to, because if you do a short term on those, they're very, very expensive. But then there's another thing. Can a hard money actually be fixed? So hard money has pretty much a short term, kind of weeded out of the midterm. Like let's say you could do a 12-month, you could do a 24-month, kind of doesn't really go into the 5-year part of it, or 3, 4, 5-year part of it, but it does go into the 30 and 40-year part of it. The 40-year part of it, currently as we stand, hard money fixed 30 years is less expensive than a conventional conforming loan through Fannie Mae or Freddie Mac. We're actually running on a 30 money on a hard money, 80% loan to value, and we could actually do that on a 5/1 adjustable rate, 7/1 adjustable rate, and a 10-year interest only, and a 30-year fixed at 4.25%, which is about 1% less than it is if we went into the conventional on the Fannie Mae and Freddie Mac side of things. So let's go ahead and go with the requirements. So rates are starting at 4.25%. Loan to values on a purchase is going to be 80% purchase. They do 5/1 adjustable rate mortgages, 7/1 adjustable rate mortgages, 10/1 adjustable rate mortgages, interest only, of course, and a 30-year fixed, fully amortized. These are 1 to 20 unit properties that you could go ahead and do, and that includes, of course, townhomes. The loan amount on these are going to go ahead and have a ceiling of $2 million. No business entities are required. So whenever I said no business entities are required, majority of people, especially that real estate investors, are really savvy. We never ever put any home under our name directly. We're either doing a 1031 exchange, and a 1031 exchange, we have it under an LLC, which is conjoined with an S Corp for tax purposes. So no business entity is required. You could actually just do it under your own name. But to give you an idea, that's how we normally do it. Minimum DSCR on this. Now, a DSCR is going to be a debt service cover ratio. That just means that the total rental amount that you have coming in is going to cover the total debt that we're going to go out and propose. So for instance, if there's like a $3,000 principal, interest, taxes, insurance, the mortgage or the rental payments that you have coming in is going to be at $3,000. That is going to be an even wash. That's going to be a 1-to-1 ratio. That's a covered ratio. We could go up to 1%. You don't want to go anything below 1%. Ideally, you want to stay at 1.25% and or above. Foreign nationals are okay. Foreign nationals is just going to be somebody that does not have any citizenship here in the state or in America. In United States, actually, because we do have North America and whatever, Canada's up there. But in the United States, foreign nationals are okay. So that means that if you have no citizenship in the United States, you are still good. And then we have what's called warrantable and non-warrantable condos, which are okay. Now, what's a non-warrantable condo? A non-warrantable condo is just a condo. Now, what's a non-warrantable condo? A non-warrantable condo is just going to be... Now, every county is going to be different. States are going to be different. But for the most part of it, if one investor owns more than 10% of the entire community, or if 50% of the entire community is rented out, that would make it a non-warrantable condo. Now, there are different parameters, but that's for the gist of it. But yeah, as far as hard money loans, yes, they can be fixed. Yes, they can be short-term. Yes, they're great. Yes, they can be bad. And yes, the only time that you will ever run into a hiccup when it comes to like hard money is if you made a mistake on your own, because there are extensions. Like let's say for instance you did a 12-month, you can do an extension on it, and then when extensions end up being a little bit more than expensive side, but the whole thing of it is going to be expensive. So try to use it to your benefit. Try to make sure you have all your ducks in a row, and try to make sure that you don't get out of hand with running your total cost on your rehab longer than it should, and you should be good to go for up to 50% commission rebate. 0% listing fee, and any mortgage assistance, link in the description below. Thank you for watching. Like, subscribe, comment, all that other good stuff. Until next video, guys, thank you again.